Welcome back to the Dividend Diplomats YouTube channel, everyone. You got Lanny for the Dividend Diplomats. We are pumped up, everybody. We are excited. We are ready to go. Today, we're going to talk about 3 undervalued dividend stocks to watch.
And before we do, you know the drill. Smash that subscribe button. Give your boy Bert and Lanny a nice thumbs up. The Dividend Diplomats talking to you about Bert's 3 stocks to watch right now.
That is absolutely right, Lanny, because you know what? On the journey to financial freedom, we cannot leave any stone unturned to find an undervalued stock to buy to grow our passive income. And what's going on with the market this week, Lanny? What are we talking here?
Tell you what, I know we always break down what good old S&P 500 has done during the week. And this has been a very, I think, interesting week because almost each day where S&P 500 has started and where they have finished almost have been completely different every day. They may start green but finish red. They may start red but finish green. For all of the investors out there that follow the stock market, probably know exactly what I'm talking about during this past week, of October 4th. But they actually finished the week up. They actually finished the week up about 1%, up a little over 40 points on the S&P 500, almost at 4,400 in the S&P 500. So the stock market is up, not down. But at the end of Friday, if you bought stock at the end of the day, you're probably happier than those that bought stock at the beginning of the day.
Yeah, and it's been an interesting month for the market too. If you stretch out the time frame we're looking at over the last month or so, the stock market entered in at 4,500, right around there. So it is down over 100 points, down 2%. So I think Lanny's summary of what's happened in the last week has pretty much been the story for the last month. The market's kind of stuck in neutral. Some days are good, some days are bad. It's been interesting to follow, especially for the first 9 months of the year where the stock market couldn't have a down day. So it's been interesting.
And as us dividend investors, we love down days because down days means sales. That means discounts. And if you're a buyer of any product, good or services, you like buying things when they're on sale. So things are starting to go on sale, including the 3 stocks that Bert put together. And I'll tell you what, these 3 stocks coming out of nowhere, these are great 3 stocks to buy and hold. And Bert, I mean, you really put a good list together here.
Thanks, Lanny. And how did I put the list together? Using the Dividend Diplomats Dividend Stock Screener. We got the 3 metrics of our stock screener, which include PE ratio less than the S&P 500, payout ratio less than 60%, and a history of increasing dividend, where we look at the dividend growth rate and how long a company has increased it. And then the bonus metric, the dividend yield. So like we do every day, every week, we run the companies through the thing. And yeah, these are 3 stocks that just popped up off the radar. I'm excited to talk through them and see which ones we may be adding this week.
Yeah, we love dividend stocks. And, the big component to that metrics that Bert talked about was that 3rd metric, dividend growth, because you obviously want that income to grow automatically and passively year after year. And, I think these 3 stocks here really demonstrated that income growth.
Yep, that's right, Lanny. So everyone, let's start in here. Let's jump right in. That first company on the list, we're heading to the technology sector, where, to truth be told, historically, I have been underrepresented in my portfolio. So any chance I can get one of the big, large legacy tech companies in my portfolio as a stock to watch, I'm always excited. That's why the first company we're going to talk today is about Intel, ticker symbol INTC. So Intel's price continues to remain in the low $50 per share, low to mid, I should say. So that is why Intel keeps popping up on our radar. Year to date, the company is only up 8.34%, which still lags the market despite the market's last month. And over the last 52 weeks, they are only up 1.87%. So obviously the chip shortages, we all know about them. We all heard about them. Intel's facing the same pressures that everybody else is, and they're also facing some pressure from AMD and other people in the sector that's caused their stock price to drop after their last earnings release accordingly.
Hey, Bert, what chip's in your computer right now?
Intel Core i5.
Wow, I'm pretty sure I'm rocking on an Intel right now as well. I think I know the management, Bert. What was management saying about what they're trying to do to address that chip shortage.
Yeah, they're getting ready to build some factories here in the United States. They're getting ready to expand their capacity here. So that, yeah, this may be a short-term blip in the supply chain today, but they're just taking the long-term steps needed to make sure that this kind of blip doesn't happen again in the future. So it sucks for right now for Intel and so many other companies, but in the long run, it's going to be better for the company.
Exactly. And, Intel's been around for a long time. This is one of those legendary, iconic type companies, that you really don't want to, really doubt. They've done it and they've done it again. And they've kind of persevered through a lot of tech changes as well. When I mean persevere, I mean, when you think of the desktops to the laptops to the tablets to the smartphones, the transformation of the industry, they've been able to kind of keep pace and still be that market leader, even though there's all of these significant changes in the marketplace.
Yep, fantastic point. So let's run them through our stock screener. The prices are as of 10/8 close. So keep that in mind for the rest of the video. Intel stock price closed at 53.81. Their forward earnings based on average analyst estimates are $4.79. That gives you a PE ratio of 11.23. And where's the market sitting, Lanny? Probably what, about 35x for PE?
First, yeah, I mean, 11 PE ratio for Intel, very low, especially in the industry when you think of the tech industry. But yeah, the S&P 500, their current PE ratio is over 34 times. So this is only 1/3 of what the S&P is currently trading at, Bert. I mean, that's a great first stock metric.
Yeah, so let's move into the second one. Their annual dividend is $1.39. You divide that by the 479. Their dividend payout ratio is 29.02%. Again, Intel passes this with flying colors. And typically we like a 40 to 60% perfect payout ratio, but I'm actually okay with a slightly lower one because, as we said, they're going to need to invest in factories. They're going to need to invest in so much to continue their growth. Tech companies can't pay out too high of a dividend here, so it doesn't hurt that they have a lower payout ratio.
Yeah, I mean, there's just extreme safety to the dividend for Intel, extreme safety, dividend growth going forward should very well be there. To dive into that third dividend stock metric, dividend growth, they've had a pause here and there, but they have 6+ consecutive years of growing their dividend for Intel. Again, Intel stock ticker is INTC. Their 5-year dividend growth rate on average is a nice, solid, and sound 6.14%, well above current inflation and well above the long-term inflation rate, Bert.
Yep, and moving into that bonus metric, the dividend yield. Their yield at the moment is 2.58%. So great yield there for a tech company, and it sure as heck crushes your savings account, as we always like to cover here.
Exactly. So to summarize, Intel, why they're on Bert's dividend stock watch list right now, is a great stock to buy. PE ratio is only at 11.2 times earnings. Dividend payout ratio at 29%. A nice consecutive dividend growth streak of 6+ years with a 5-year average of over 6%, with a very solid dividend yield, which is almost 2 times the S&P 500 at 2.58%, brother.
Moving into number 2, everybody. Dividend stock number 2 here. We're staying in the technology sector. We're not leaving the sector. So get excited. Wait, what is that? 2 tech stocks on my launch list here. What is going on, Lanny?
Just going tech on us?
I guess so. You know me. There's one person that's known for tech. This guy here. That
you
being
do
said,
work at a fintech company.
I do. Yes, I do. Still doesn't mean I'm tech savvy. But yes,
You're so techie, dude. You're so techie.
You know me. I might as well just move out to Silicon Valley right now.
You're Mr. Silicon Valley.
Let's blow this budget out of the water and go in San Francisco.
You're not Mr. Vegas. You're Mr. Valley. You're Mr. Silicon Valley.
Yeah, you know me. You know me. All right, everybody. Dividend stock number 2. Qualcomm, ticker symbol QCOM. This is the first time they have ever popped up on my dividend stock watch list, everybody. So get ready, get excited, get hyped up. What really caused them to pop up on my watch list? The stock is down over 10% in the last month. So when I ran my screener, I was a little shocked to see Qualcomm popping up on there. Over the last year, they are down 14.78%. And over the last 52 weeks, they are just barely up 1.35%.
Wow. I mean, and Bert, given a little bit of background, on Qualcomm, obviously they're large in semiconductor software. You've got their chips well within the smartphone. You got the Snapdragon. I'm pretty sure everybody knows about the Qualcomm Snapdragon being built into a lot of those smartphone devices. It's very popular, high speeds. Honestly, what's great is it's a very nice recurring business model because they keep incrementally improving what they can do for smartphone devices.
And that was actually one of the knocks too with Qualcomm, is that they were so heavily focused in the handheld smart devices. There is what's going to happen if there's a pullback. So the good news is Qualcomm at least took a step to address that here in the last few weeks by announcing a major acquisition of Veoneer. I think I pronounced that correctly, for $3 billion to add to their auto parts business. And what Veoneer does is what advanced safety. They have they were working on self-driving cars. So you can see where Qualcomm's moving. They're taking their technology expertise, adding in a huge part to build into their auto business. So now we'll start seeing if Qualcomm can diversify out from handhelds and start making a move. As you know, a lot of the cars are heading towards automated driving with your Teslas, or even your more sophisticated driving with what Ford, GM, what they're all building towards the future. So it's an interesting play for Qualcomm, that is for sure.
An interesting but confident play by them. And, Bert, as you were saying, stock price for Qualcomm as of October 8th is $126.55. Is it time to push them through the DD stock screener?
Let's do it. So yeah, that first metric, PE ratio 126.55, divide that by their estimated forward earnings of 826, gives you a PE ratio of 15.32. So higher than Intel, but still way below the broader market.
Very nice. Very nice. And fairly inexpensive, showing some slight discount metrics there at the price to earnings.
Yeah.
But that second metric, that dividend payout ratio, Qualcomm currently pays over the course of a year $2.72 to their dividend. So you take that over that forward EPS that analysts are expecting at 826, you've got another low dividend payout ratio similar to Intel at 33% approximately for Qualcomm.
Yeah, it's fantastic. There again, similar to what we said with Intel, dividend is very safe, but they also need to invest. The tech companies have to put money into operations, so it's okay to see a lower payout ratio than our perfect payout ratio range in that sector. Moving into that third metric, the dividend growth history, their 5-year average dividend growth rate is 5.69%, and they have increased that dividend for 10 consecutive years too. So I like how they're hit the double-digit mark from the dividend growth history standpoint. They're on their way to becoming a dividend aristocrat.
Double digits for this tech company, very solid to see. I agree with you, Bert.
Yeah, and although their last dividend increase was just below their average, it was 4.6% in April. So it looks like, after you.
I'm going to say that's exactly, what I was, going to mention, but you're spot on.
And lastly, that bonus metric, the dividend yield, their yield is 2.15% at its current prices. So it's nice to see that yield climb above 2% for Qualcomm, which has been helpful considering their price has come down slightly.
One thing I'll mention about Qualcomm and their dividend yield now being over, over that 2% mark. They've had so much appreciation over the last, I don't know how many years we actually break down Qualcomm. If you go over their 5-year track record, Qualcomm's up like 100%, I think, in 5 years. So I hate to even say that, because obviously they're down year to date, but over that 5-year path when they were trading at barely, I think in the $50 to $60 range, and they're now over 120, you know, their yield has snuck downward. So it's nice to see it kind of coming back with the price decline this year.
It's fascinating. So yeah, let me just summarize this here quickly. P ratio of 15.32, payout ratio of 32.93%, 5-year DGR 5.69%. And they've increased that dividend for 10 consecutive years with a yield of now 2.15%. So should we move into the third company here, Lanny?
Bert, let's hit him with the left, hit him with the right, and finish it with the rocky uppercut.
Yeah. All right. Let's bring in Brett Favre here to talk about this last company here. This
Real
one,
comfortable Jane.
yeah, this one is definitely a new one on the stock watch list, and it kind of popped out as an offshoot of one of our recent videos, the dividend increases in October, where we talked about how VF Corp is set to increase their dividend in the coming month. It started, obviously, once we started pulling back the research, you'd remember that a few years ago, they spun off a few of their brands. They spun off Lee, they spun off Wrangler, and they spun off Rock and Republic into a new company called Contour Brands, ticker symbol KTB. When I looked at the metrics for Contour, I thought they earned a small spot on my watch list here. Very excited.
Bert stepping into retail, you don't do it often. So this is very exciting to see you taking a look at them.
Yeah. And I mean, obviously, with the brands like Lee, the Wranglers, that's kind of what jumped out to me. If I'm going to go into retail, I want it to be companies that have those strong legacy brands. And I think everyone can say that Lee and Wrangler would check those boxes that have been around for decades, that are on shelves everywhere in the major retail stores. You go into Target, you're going to find them. You're going to go into Kohl's, you're going to find them. And they're the brands that people want. They're affordable price points for a lot of people, which is why I just like the brands.
Bert, brands like Bert. So Bert, these three iconic, obviously denim brands here with, Wrangler, Lee, and Contour. I'm about to call you Mr. Denim now. But they're currently trading at $48.21. But what has their stock price done in the last 52 weeks?
Yeah, their stock price has exploded over the last 52 weeks. They're up 75%, and year to date they're up 23%. So you may be asking, how on earth are they still an undervalued dividend stock to buy? It's what the metrics tell us. The metrics tell us that story of they're still undervalued. And unfortunately, we cannot go to a 5-year history level like we did with Qualcomm there at the end, because they've only been around for a couple of years here since they were spun off in 2019.
Don't hate the player, hate the game. So what is that first dividend stock metric of the price to earnings ratio, brother?
Yeah, their price is $48.21. Their forward EPS is $4.12. That gives you a PE ratio of 11.70. Undervalued.
Low PE ratio. I mean, I'm wondering what they were, a couple months back. I mean, wow. Very good. What's cool about them is obviously, they're not the store, but they're the brands in stores. So that kind of helps them kind of reduce their risk because they're not so concentrated from just like a pure retail brick and mortar standpoint.
Excellent.
That second dividend metric, though, I mean, is really cool because their dividend currently per year is $1.60 spread throughout the year. Based on those current forward earning expectations from analysts at the $4.12, that means that their dividend payout ratio is another low one at only 38%, Bert.
Yeah, but again, we haven't even had one that's been a perfect payout ratio. So moving into that third metric, the dividend growth, this one's going to be a little bit different because they've only been around, spun off for a few years. I do want to note VF Corp is a dividend aristocrat, though. So the company that they were spun off from has a long-term history of increasing their dividend. But Contour got off to an interesting start after the spin-off. They initially set their dividend at $56 per share, and then they suspended it for a quarter after the onset there. Then in October 2020, they reinstated that dividend. Probably it was suspended in conjunction with the pandemic, like we saw with so many other companies. Once it was reinstated in October 2020, it's remained at that 40 cents per share level. So wait a second, it's October, Delaney. It's been a year. Could this be the one where Contour also increases that dividend?
I think we're going to have to wait and see, my man.
Yeah. Yeah. So then that's really where their history is. There's not much of a history, but they have that long-term history of an aristocrat. Brief pause from the pandemic. They're back, and we'll see if they continue to increase it. You want to talk about that fourth metric, that bonus metric, Lanny?
Bonus metric for KTB, Contour Brands, with that dividend and share price currently yielding 3.32%, easily 2 times the S&P 500 plus that. So 3.32%, definitely a great yield.
Yeah, so one thing also to call out after our metrics here is for companies, we will like to look at the balance sheet every once in a while too. The current ratio measures the company's ability to pay their short-term debt. So can their short-term assets cover their short-term liabilities? For Contour, that ratio is fantastic. The ratio is 2.1x, meaning double the assets compared to their liabilities. However, when you look at the company's overall debt picture, it tells a slightly different story. Their debt to equity ratio, it's 5x. So there is a lot of debt. It's just longer term here for Contour. In the short term, they have plenty to cover their short term. Long term, this is a levered company. So that is one thing to keep an eye on here.
It's good to point out, though. I love looking at the balance sheet to see how liquid and fluid that they are. In summary, for KTB, you're dealing with a PE ratio of just under 12 at 11.7, a dividend payout ratio at just under 40%, a nice solid, dividend growth rate of nothing, but VF Corp being an aristocrat plus something that could happen this October, and a solid dividend yield of over 3.3%.
So everybody, those are the 3 companies on my watch list: Intel, Qualcomm, and Contour Brands. Let us know in the comment section your thoughts on the 3 companies. Are you watching the 3? Are you looking elsewhere in tech, or are you not even considering Contour as well? And do you have a different company on that 3rd spot? Let us know your thoughts, and if any of your companies, how they performed in the stock screen.
Burr, which one's your favorite right now out of the trifecta here?
Qualcomm. I think Qualcomm is top of the list, and there's probably more likely than not that I will be initiating a position in my portfolio, and possibly even my wife picking up a few shares here or there. I think it would be nice to have another tech position in there, because I really have IBM, Intel, Cisco, the 3 big legacy ones in there. Adding in a company like Qualcomm can't hurt.
Nice. There you have it, guys. Qualcomm at the top of the list. Let us know how many of these 3 that you own. Bert, anything else?
No, again, everybody, if you haven't already subscribed to our channel, give this video a nice old thumbs up. We appreciate all the support over the year too. And everyone, happy investing. Let's keep pushing. Let's grow our dividend income.
That was Bert the Hurt, and this is Laney from the Dividend Diplomats. Over and out.